This is Anthony Parent of Parent LLP, and thanks for joining us on the IRS Fresh Start program. And for those just joining us, this is part 4. We're going to talk about installment agreement successes. Joining me is our tax resolution team: Jillian Terrell, Michelle Wynn, Bob Lyon, Tim Pepe, and Michelle Palmieri. So let's talk about installment agreements under the Fresh Start program. Way back when I started tax resolution, there was always something called the streamlined installment agreement. It was under $25,000, and it was pretty much available to everybody. It was nice because you didn't need to submit any financial documents, and that $2,500, if you were about that, it came out to about $500 a month, or like a car payment. And now the IRS has made some changes to this, and I am going to point to someone to explain the changes. Who wants to explain the changes? Michelle Palmieri is being volunteered. Thank you, Michelle.
Basically, the change to this was to increase the threshold so that people that owe $50,000 or under could request a 6-year installment agreement, and providing limited financials. So
limited, so you didn't have to provide the whole 433F if you're dealing with ACS, or a whole 433A.
You had to fill it in and maybe provide some items, but it wasn't like working with appeals or a revenue officer. And for under $25,000, you still do not have to provide financials.
So the real big change is there's a streamlined program that kind of came in between $25,000 and $50,000, where they're just going to accept what you're saying at face value. They're not going to look for substantiation.
Correct.
Okay. And now, before, the old way, if you owed that $25,000 to $50,000, you had to submit those full financials as if you were going for pretty much an offer in compromise. It was really that sort of standard, and so they've relaxed that a bit. Now, if you are, and then one of the other things they've done is they changed the repayment. Michelle, Michelle Wynn, do you want to handle this?
Well, there was just an issue I wanted to clarify, is that under the new rules, up to $50,000, you're allowed all of your conditional expenses, which means those types of expenses that the IRS typically doesn't take into account, like your child's college tuition.
A fancy mortgage?
Yes, that's one of the #1 things, is an expensive mortgage. And under the old terms, the IRS would take into account some of those expenses, but only if you were going to pay off your tax liability in 5 years. Now they increased it to 6 years, that they'll take into account some of those expenses at their discretion, which means they don't have to allow it, but they can.
Thank you for that. Now, I have one question. I know about something. I know a little bit about tax resolution, and I know there's something called a 1-year, 5-year. Is that related to the Fresh Start program at all?
Not at all.
It's not at all, but it's a great rule. It can be a really effective rule where you get your conditional expenses, and you can get a lot of conditional expenses for a year, and then enter into an installment agreement after that. That's a really great thing. So that's kind of funny. It's not even part of the Fresh Start, and that's one of the best installment agreement programs and additions that we've seen come out recently.
Anthony, I would like to kind of have you join me here in a brief discussion to compare the old standard to the Fresh Start standard. I think that a lot of folks say, oh, well, the IRS is willing to extend an extra year. That's wonderful. That's great. I'm willing to sign on to this installment agreement, when realistically you're looking at a pretty insignificant difference between the 5-year payment and the 6-year payment. And you and I probably can both relate to the fact that if money is truly that tight, that it might not be your best option to enter into an installment agreement based on these new rules because of the risk of default.
You're absolutely right there, Tim. Because if you look at the difference between paying, let's just say that you're maxing out and your balance is $50,000. You just get into that. Under the old rules, you're looking at about $962 a month for 5 years. Under the Fresh Start, you're looking at $819 per month for 6 years. And so you're really looking at what looks about a $140 difference. If that $140 difference is going to make or break your financials, that is a really tight way to live for what is 6 years. And one of the other things that we hear a lot of is that people will call the IRS, and they will think the IRS is on their side, and they're not on their side. They represent the government, but the people are friendly enough, right? If someone's friendly, they must be on your side, right? And so this is what happens so much, is that the collections officer will say, well, you owe $70,000, you owe $100,000. Can you borrow enough, get some money, liquidate an IRA to get it down to this magical $50,000 number, and then you'll qualify for this fresh start installment agreement. But we just explained how this fresh start installment agreement really isn't that great for you. And now you've just liquidated something that might have a tax implication, giving you a tax bill. Then once that tax bill hits, you won't have enough withheld, and now that tax bill hits and you just defaulted your fresh start agreement. And that's what we talk about when sort of the IRS can bait you into situations where you default. Have you ever seen anything like that?
You're absolutely correct, Anthony. We have seen that in the past. And I think if we remember back to part 1 of this video series in this webinar, you'll remember the myths surrounding the fresh start, and the fact that it is still a struggle if you have a defaulted installment agreement or a defaulted offer under your belt to enter into another resolution proposal. So that is the frustration that some of our clients or potential clients run into when trying to take advantage of the Fresh Start program.
We're going to talk about IRS Fresh Start Offer and Compromises Success. This is Anthony Parent and Win LLP. On behalf of our resolution team, thank you for watching this video, and we look forward to seeing you in part 5.